my opinion, seasonals are not as important as they once were. And that's simply because you have China and you have India demanding huge, well, the whole world demanding huge amounts of physical metal. And the problem with LBMA and the problem with CME is they cannot print or mint non-existent silver. That's the problem. I think what you're watching are the physical markets taking over from the future markets. In other words, the dog is finally going to wag its own tail rather than the tail wagging the dog.
How much physical is actually getting moved over there. Obviously, the arbitrage still exists. So lease rates have pulled back. We're not going to fail in March. So everything is more or less normalized from where I sit. Looking at this market for over 40 years. Doesn't mean that we're not going to see some more fireworks ahead. I think we will. In fact, I think January is probably the precursor to what we'll see at the very end. And at the very end, we may be unobtainium and you either have it or you don't. But I don't think we're there yet. I think we're going to see some congestion here and the market's going to be, quote unquote, more normal at a much higher level.
The global silver market is entering a historic shift as physical demand from China and India tightens supply. According to precious metals analyst David Morgan, futures exchanges like LBMA and CME cannot create physical silver that doesn't exist, signaling a potential power shift from paper markets to tangible metal. This growing imbalance suggests physical silver may soon dominate price discovery. Market commentator Bill Holter warns that while lease rates have stabilized, long-term pressures remain. Investors could see higher price levels and potential supply shortages, making physical silver ownership increasingly critical in 2026 and beyond. Now, we present the clips from Thayer's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Based on what's sitting in the registered inventory and the eligible, we're 100 million ounces greater in inventory January 2026 than we were in January 25. 100 million ounces of physical, not talking about printing press. And this rollover thing is misunderstood by too many in the industry. They don't understand that there's a huge amount that gets rolled over into the next delivery. And why? Because what Bill teaches, everything is credit. And they have a physical metal that they own. They're going to put it up on credit, which is the futures market. They're going to get that 1% per month on leverage. If you got 1% a month and you got a 10-to-1 leverage, that's what your interest rate is. And they do it over and over and over. And it's been that way since I've been studying the market at that level. I mean, I don't know much about the CO. I was the first guy to learn about Ted Butler. He and I were the only guys writing about silver now. Got his phone number, called up Jupiter, Florida. Hey, is this Ted Butler that's writing about silver on gold? I forget the name of it. Help me out. Vronsky's website, Gold Eagle. He said, yeah, it is. And I said, hey, man, I want to learn from you, tell me about this. So I really got in. I've been a futures trader for a living. So I had, a pretty good background that most people would talk about never have done. But I've never been a futures broker. Anyway, I digress. So I learned more and more. But it's going to fail when it fails. It's not this month again. But what Bill says, I'm in alignment. And that's why, if you want to show it now, Danny, and show that Word doc that I sent comes from Matt Watt, an analyst, friend of mine. And what that shows you is what the ongoing supply deficit looks like for silver over the next decade. And what we see is everything above that red line is got to be taken from above ground inventory. Well, you don't have to be a rocket scientist to see that. You don't have to go out too many years and you've basically, at least in theory, eaten up the entire above ground silver supply. Those are all facts. Now, whether he's got the exact amount of solar need in the year 2030 or not, I don't know, but it's a good educated guess. Same thing with brazing, same thing. The only place I really disagree with him, and I think Bill would agree with me, is that the grayer, the silver bars at the very top are investment demand. And he has that as a robust 200 million ounce annually and never increasing any years going forward. I disagree. I mean, you look at how the ETF in India and you look at what Shanghai's doing, I think those bars are going to be much higher than what he forecasts going forward. So what I'm implying here is that the amount of silver above ground that would have to be met for all demand, physical demand for industry, physical demand for investment, will in theory run out a lot sooner than what it shows on this chart. So you can't be more bullish than just looking at this fact alone. And at the top, it says silver demand low case. He had a case that shows even greater demand in the higher case, which I didn't want to show. I want conservative on what I pretty much could prove. Now, we could go on. The only place that you might really push back is where I did. Investment demand will be weak, or what he shows. I disagree. And you can make an argument. There's some guys out there saying solar will be replaced with scrap copper. It's possible, but really not very probable. So, I mean, this is all you need to see. I've shown this a couple of hedge fund managers that have decided that gold only isn't the way to go. They wanted to put silver in.
What you're talking about is supply and demand is outstripping supply. It already is. It has been for the last at least 5 years. I mean, it's already, you could argue that since the year 2000, there's been more deficit years than surplus years. And going forward with the different uses of silver, that deficit is going to widen. The other thing is, and I've not really heard anybody talk about this before, but think about this. If money supply is growing, what's the number? 5%, 7%, 9%, whatever the number is, that far outstrips the mine supply that's growing, between 1% and 2%. And at this point, we've pretty much peaked out. So just from a nuts and bolts standpoint, the more money they create, stuff will cost. When I say stuff, anything, a cup of coffee, an ounce of silver, an ounce of gold, whatever, over time, inflation is built into the system because they have to increase money supply. They have to increase debt because the system is a Ponzi scheme. There has to be more new capital coming into the system day after day after day. That cannot cease. Now look at that versus gold and silver supply. At best, that's grown at 1% to 2%. And now it looks like, we're close to, if you want to call it, peak production.
Rising silver inventories may appear bearish, yet the bigger story is structural deficit. Even with 100 million more ounces registered in January 2026 versus 2025, long-term supply remains strained. Analysts like David Morgan emphasize that futures rollovers mask true physical tightness as traders leverage metal for yield rather than delivery. Meanwhile, commentary aligned with Bill Holter highlights accelerating industrial demand from solar, electrification, and global ETFs. With mine supply growing just 1% to 2% annually against expanding money supply and persistent deficits, silver's above-ground stockpiles could shrink rapidly, supporting a powerful bullish outlook for the decade ahead. Let's get back to the interview.
And Wall Street is going to pay attention sooner or later. The Druckenmillers and some of the real savvies are already in this space, but the Johnny-come-latelys, the follow-the-leader types, they will come into this market. And really, remember, the ETFs were started so that stock investors could buy a commodity because Section 7 people cannot buy commodities for their clients. So ETFs were created. That's where the GLD was the first one, and the SLV was not far behind. But now, do you want the golden goose or do you want the golden egg? If you want the egg, buy the ETF. If you want the golden goose, buy the mining companies. You're buying them at a discount. You're buying that goose for half price, so to speak. It's going to keep laying more gold eggs and more gold eggs. Why not take part of that? I'm selling my book. I do specialize in resource stocks, not just gold and silver. But let me tell you, there aren't too many clients I have that are unhappy right now. I've been in that mine a few times, but I did an analysis back, 15 years ago. What I do know is the price was $17 the ounce. But the true cost, not the cash cost, which is kind of BS, but the true all-in sustaining cost was 17. So they were mining silver at a high grade, but they weren't making any money. Why? Because in the United States, you have workman's comp, insurance, healthcare benefits, dental care benefits, pension plan. I mean, of all these things for a U.S. worker that you don't have in Argentina or Mexico. So that puts it, I'm really trying to emphasize what Eric said. Now, if you get let's say a living wage out of the mining industry and you're selling silver at $90 and you've got real earnings, now you have a margin where you can pay American wages and get metal and bring it to the fore. So I think it's a good thing. I'm not for inflation, but I'm for real wages in the real world. And honestly, I think the working conditions should be better than they are in most countries. I'll just digress for a moment more, but I've been in Argentina and I feel for those guys. I mean, they're away from their family 6 months, living in tents, working 12-hour days, and they don't get very good food either. I mean, that's kind of, that's the deal about the mining industry. I mean, it gives you a real look at how the other half or most of the world lives. So maybe I went too far on a rant, but honestly, yeah, I think it helps the whole industry if we have wide margins that are reasonable, and if silver decides it's $200 an ounce, so be it. Let the market decide. As Bill said, let's hit this dog wagging the tail for a change and see what happens in the industry, from the miners to the explorers to the exchanges and everything else.
The mining industry was starved for a full decade, more than a full decade. And very little exploration was done. There were no big elephant mines found. And I mean, it goes directly back to supply. I mean, if you're not drilling for it, how are you going to produce more in the future? But now there are margins. Now you will have mines or companies, drilling their properties out. I mean, a perfect example is the company my biggest position is TRX, Jim's company. They didn't have the cash flow to drill out the full property. They only drilled out maybe a third of it. Now they've got cash flow. Now they're going to be able to drill. Now we're going to find out. I mean, the reason I bought in to begin with was because of the property. I believed, after looking at the geology, looking at the 43101, I believe they've got much, much more metal in the ground, but we would never know if they didn't have the cash flow to drill. But now they have the cash flow to drill. The thing about the mining industry, it's not like oil and gas. You don't poke a hole in the ground and within 60 to 90 days, you have production. The way it works in the mining industry, you put drills in the ground today, you're going to be totally lucky if you pull 1 ounce out within 3 years. You're looking at a 3 to 5 year time frame or longer from finding metal to being able to produce that metal, produce it efficiently. So it's like David said, it's all about margins, and the margins are finally there for the mining industry. And hopefully they learned their lesson from the 2007, 8 to 2011 experience, where these companies spent like drunken sailors.
Wall Street's smart money is rotating into precious metals as supply constraints and stronger margins reshape the mining sector. Legendary investors like Stanley Druckenmiller have already shown interest, signaling institutional validation. ETFs such as SPDR, Gold Shares, and iShares Silver Trust open the commodity door for equity investors. But miners now offer greater upside leverage. Analysts including David Morgan and Bill Holter stress that rising silver prices improve all-in sustaining costs, enabling exploration and production growth. After a decade of underinvestment, expanding margins could spark a powerful bull cycle across gold and silver mining stocks. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.